going on, you guys? Anthony here from Marketchartwatch. Today we're going to be looking at fair value gaps right here, and I'm going to show you a super predictable move. So number one, let's draw in two of our fair value gaps. You can see we got a gap here. Draw that in. And we've got another gap right here. So both of these are pre-market moves. Okay. And let's come in on this time horizon a little bit. So you can see trading today in pre-market from last night, we had a gap formed. Let's get that out of the way. A gap formed from the high of the pre-market to the opening, or sorry, the high of the after hours to the high of the pre-market. And so there is a gap here. And whenever you have a gap, this basically means that there is a imbalance of order flows, right, to the buy or sell side. And whenever that happens, typically the market will want to retrace in that direction to fill in that gap to remove the imbalance before it finds either support or resistance and takes off in either direction. And so the move today was a classic example of that. We created a fair value gap pre-market when the market opened right here for us on the West Coast at 6:30. You can see that we immediately tried to backfill into this fair value gap, and once we did so, what have I said before in previous videos, we try to retest that gap to the support or resistance side before making a determination on direction. And you can see we rejected, and once we rejected, it was a very high probability move back to the bottom of that channel before we broke out of it. And you can see after hours we are dead flat in trading because now we're stuck in between two fair value gaps. So let's take a look at what the market makers want to place as a bias for today. And I'm going to make an assessment here and say that they're going to make an assessment that will probably move somewhere to like 0.6%, between 0.6 and a 1% move is going to be my guess. Well, I don't have much time here, so I'm going to take a look and see what the S&P 500 closed at. It's 563.51 for SPY. So let's do 563.51. We split the difference. We're going to look at the 564 call price of 181 and the put price of 274. So they're pricing in a move a bit to the downside. At least that's their bias. And when we do the math, that's approximately 0.6%, so 0.68%. They have an implied move. It's going to cost more to buy the put option. But what's interesting about this is if we look at the implied price, you can see that that 0.6% is actually implied to the upside. Okay, just so happens to be. And then if we look at that same move, that 0.6% is implied also. If we look at to the downside, that brings us back into the fair value gap. So what does that mean for tomorrow? Well, if we take tomorrow and we decide, okay, what do we plan to happen? Well, this pre-market is going to give us the trend bias. Okay, so it might bring us down to here or it might bring us back to here. At either point, we will either retrace off of this fair value gap or this one, right? Because the market is going to want to touch either one of these and break into it. So we just have to see what the morning bias holds. Now the market makers say that the bias is downward, but when we look at the confluence trend over the last 14 days, that move has really been to the upside. So that's what I'm predicting for tomorrow. Will be an interesting day to see what we do. I'm going to guess low volatility based on this fact, but once we do break into one of these channels, we're off to the races, and I'll be placing either call or put side bets once we are in those. Anyways, thanks for watching. Like, share, and subscribe. We'll see you in the next video.